Good morning. This is Sean Murphy of SK Murphy. I'll be the MC for today's PATCA briefing on Bay Area real estate economics. PATCA is the Professional and Technical Consultants Association. Learn more at patca.org. The best way to get started is to join as an associate member for $50. You can contact me if you have questions. We're fortunate today to have Jed Thibodeau as a speaker. He is a Bay Area licensed loan officer and a founder of the Mortgage Lens, which is an application that helps people walk through purchase decisions. Jed will walk through the economic forces shaping the market, including rates, supply, lending standards, and the higher rate environment, and then analyze what a Bay Area buyer needs to make a good decision. Jed.
All right, thanks, Sean. Okay, I'll just jump right into it. And I think we talked about, if you have, Jim, if you have any questions as I'm going through it, feel free to chime in. I think Sean said he'd monitor the chat as well for questions. So, okay, we'll get started. I'm going to start off by talking about kind of going through mortgage rates. And let me move the pictures out of the way here. Okay, so here's a chart of the blue line is the average 30-year fixed rate going all the way back to 1970. And the red line is the 10-year Treasury yield. And the reason I wanted to show this chart is to demonstrate that the 30-year fixed mortgage rate and the 10-year Treasury yield really move, they're pretty much in tandem here. They move very, very closely together. You can find some instances where, if you look closely, where they diverge a little bit, but and in the mortgage industry, we're always looking at the 10-year Treasury yield to gauge the movement of mortgage rates. So, we see if we look back through history, you guys probably remember back in the 1980s, this was the point where the highest mortgage rates, we've seen in our probably a couple of generations, close to the 20% range, which seems crazy today. But remember, prices, 1980s prices are not 2026 prices, especially here in the Bay Area. Um, and one thing I'll talk about on the next slide is what we call the spread. And you can see there's a difference between the 30-year fixed rate and the Treasury yield here. And that spread, we call that the spread, the mortgage spread. And so when we say that term spread, we just mean the difference between where the 30-year fixed rate is and the 10-year yield is. And then also, these are average rates. Okay, so this is not the rate for everybody. As in, for example, if someone has a very, good high credit score and they're purchasing maybe with a very large down payment, so a low loan to value ratio, their particular rate on the 30-year fixed is going to be lower than the average. And then the flip side is true too, or is, maybe somebody with not so great credit score trying to buy an investment property with as little down as possible, the rate that they would be quoted and actually receive would be higher than this average. So just some context here, because rate anxiety is a pretty real thing. And, I've noticed when a lot of people look at rate charts, the first instinct is, oh, that's too high, or that seems really high, or that doesn't seem right. So I just want to preface that by saying these charts are just average rates.
Yeah, and can I just mention a comment?
Sure.
That's I believe true for most mortgages, but my mortgage was actually variable tied to the prime. I'm actually 1% under prime. Don't ask me how I got that. I was lucked out on it. So for a while I was paying like 2.25% during that
Yeah.
during that low period. It's a lot higher now, but not everybody is tied to most mortgages, like you showed, track it, but there are some, oddball mortgages where you're, above or below prime, for whatever reason. I don't know why, because it's, prime is short term and mortgage is long term, just how the
Mhm.
bank decided to do it. So,
Yeah. Yeah. Back in I'd say before 2010, before the mortgage crisis, where this recession is right here, um, there was a lot of different loan programs. I'm not sure when you got yours, Jim, but there were home equity lines of credit loan products that were going with, the margin, um, where the margin was less than prime.
yeah,
So,
and that's actually what I had, and it's my
yeah.
10-year of draw is over, so I'm now on
Okay.
a 20-year where I can't draw on it. So it's basically it turned into, 10 years you can draw, then 20 years
Right.
where you're just stuck, but it is variable. And for a while it was like outrageously cheap at 1%
Yeah.
under prime.
Yeah.
And now I've actually been paying it off. When it zoomed up a couple of years ago, I said, okay, I got some funds. I'm gonna pay this off. I couldn't refinance because I didn't have enough income to show. So
Hmm.
I couldn't refinance into a fixed. If I could have, I would have. And I'd be one of the lucky people now that's, fixed at 3% or whatever. But I'm happy though, because there's not much left to it. But anyway, enough about me. I just thought I'd mention that not everybody's mortgage is looks like that. My graph would be a lot different.
Yeah. Yeah, that's a good point. Yeah, thanks for chiming in there because yeah, this is just the average, and there's a tons of different loan products out there and different ways to structure financing. So, moving on, I just wanted to talk about this spread here. And if we look at this is a zoom in of the previous chart, and this one goes back to January of 2020. And you see here coming out of the pandemic, rates or the average rate here was dipped below the 3% level. So this is where what you refer to the lucky people that owned homes, back here and decided to pull the trigger on a refinance and lock in 30 years for a rate less than 3%, which is essentially, I would say, almost free money, when you factor in inflation rates and all that. But coming out of the pandemic, we saw rates start to rise. Well, we saw inflation start to come up, and then the Fed, which I'll show on the next chart, was a little bit slow to react due to that inflation. I don't know if you remember the headlines, but the Fed was saying inflation was transitory back at that time, and that it wouldn't be a problem. But turns out that was not quite right. And mortgage rates started to move up before the Fed started to hike rates, and then we had this little bit of a banking crisis, in 2023. If you remember the Silicon Valley Bank and First Republic Bank, they went under um, because rates moved up so quickly. And, when we saw that and we started to see this spread, move to the 3% range, even back here, you can see this is roughly at the 4% line here, and this is roughly the 7% line. So we saw this spread move from the normal 2% up to this 3% roughly. And the reason I bring that up is because today, over time, the spreads have compressed and we're at 2%. So right now, the 10-year treasury is in this 4.5% range right now. Today, I think it's just slightly over 4.5. But if we still had the spreads at 3%, back, if today the spreads are still at 3%, we'd see mortgage rates a full percentage higher than they are right now. So even though the 10-year treasury is still kind of at this range, here, we're not seeing rates up here because these spreads have compressed a little bit. So that's good news for the housing market because it's pretty interesting. When we see rates, as soon as we see rates start to come down, the market just becomes much more vibrant. But when rates come back up, the market just slows, it stops. Moving on, and here's the chart, same kind of chart, but we added a line here. This green line represents the federal funds rate. So we can see as the Fed coming out of the pandemic, they were slow to react, and we'd already seen mortgage rates right here started to come up. Or sorry, the 10-year treasury yield to come up, and then the mortgage rates came up, and then the Fed finally said, all right, we need to start hiking rates. Now, once they hiked the rates, that's what really caused this banking crisis here, because these banks, what they had done is they had written all these loans back here with these very low interest rates. And so they had these loans on their books. And, for the investors that supply the mortgage money, the mortgage, it's a fixed income asset. They receive the monthly income that the homeowner, they receive the income that the homeowner, or the income they receive is the payment the homeowner makes. And so if you're an investor supplying money to the mortgage market at this time, you could say, well, I want some exposure to mortgages. I could buy some of these from Silicon Valley Bank back here, paying me a yield of roughly 3%. Or you know what? I could just buy some newer ones that are paying me 6%. So when the rates went up so fast like this, these mortgages became illiquid, and so the banks couldn't sell them. So that's part of what caused the banking crisis back then. And the spreads got kind of wide here. And then ever since, the markets have sort of settled down a little bit, so we have lower spreads, which is nice. And then the Fed did start lowering rates. Here, that's Jim, you probably saw your mortgage rate come down as, this was the peak period here, and then it came down.
It came down a little, but it was a huge increase. I mean, it's still not, I don't even think it's come back halfway.
Yeah,
I'm
yeah. Well,
talking
because
about fund, Fed
the
funds
Fed
were,
funds rate was essentially zero all the
yeah,
way
yeah,
back here.
correct. Yeah,
So
yep. And can I also add, I think there was some mismanagement at Silicon Valley Bank. They were,
yeah, yeah. I'm definitely oversimplifying it with this my explanation, but yeah, um, there's a lot going on there.
yeah,
Okay, moving on. So here's another rate chart. Hopefully you guys aren't too tired of rate charts, but this is one just going back over the last year, and this comes from Mortgage News Daily, which is if you guys are interested and you want to see what daily mortgage rates are like, it's a little bit they're hard to find, but Mortgage News Daily is a good source. And you can see right here in 2000, or excuse me, this year, 2026, rates started moving in a really positive direction for us in the real estate industry. And we dipped just below the 6%. So, we were getting into this 5.99 range. And you could feel the market just sort of pick up. And then we decided that we needed to start this conflict in the Middle East. And as soon as that happened, we saw this really sharp uptick in mortgage rates in particular. Same with the 10-year Treasury. Um, and then we heard lots of rhetoric coming out of the administration indicating this was going to be a short, quick exercise, similar to the exercise in Venezuela, where they extracted the president there. But suddenly the markets, I think, liked all that rhetoric about how the Iran conflict is going to be quick and over decisively, and the oil flowing through Hormuz is going to start again. But then the markets realized, that's a lot of rhetoric and it's not really happening. This conflict is continuing to go. So we saw rates again move back up to this level here. And then they've just kind of been chopping around. So the outlook for rates moving forward, a lot of it is, or actually what's really driving mortgage rates more than the economic reports that are coming out weekly are the headlines coming out of Iran. So as soon as we can, get some kind of conflict resolution there, and if we can confirm that, the oil tankers are flowing, that's going to help rates come back down. But I think it's going to take more than that to get back to this level here at the 6% range. I think that, if the conflict ends, we'll come back down into maybe we could come back pretty easily come back down into this, call it 6.25 range,
yeah,
6.25. Um, but then to get back into six, we're going to need to see inflation numbers come down as well, and maybe some softening in the jobs data.
yeah. And we do have a strong economy. By the way, Jed, as we record this, I don't know if you've checked, there's breaking news about they're going to sign a peace agreement and all Trump called off all attacks. So this just
Oh,
as
really?
just as we made this recording, take a look. They're going to say oil diving straight down and NASDAQ diving straight up just in the last hour.
Oh, okay, okay. Yeah, so yeah, I've already said it. We've recorded it, so we'll see if my
And
hypothesis
it,
is right. We should see mortgage
or,
rates come down, maybe later today or tomorrow.
or Sean can edit this out if we don't want to make it look like we're a big sale or something.
Yeah,
I,
yeah.
I
Um,
just like to stick to the topic of real estate if we could, and less about other things, if that's okay.
Yeah,
sure.
and my point, and I think Jed's are they're inextricably linked because what's going on with the Federal Reserve and inflation is directly tied to where free flowing mortgage rates are going to go. So I don't think you can separate it. We don't have to put in our political beliefs or anything like that, but there's no, I mean, Jed said it himself. The biggest influence on why that's where it is because inflation and the war, whether you like the war or not. It is what it is.
Yeah, that's what the financial markets are doing. So it's a good. It just is what it is. Okay. moving on, I'll move on quickly. I like to keep track of a couple of poly market charts. These are the prediction markets. I'm not sure if you guys are, familiar with those or not, but they're some are kind of fun to look at. Now, the interesting thing on these charts is back in, in January, February, and March, if we look at the orange and yellow lines, those re represent, how many Fed rate cuts will we see in 2026? And the prediction markets were indicating that either 2 to 3 Fed rate cuts during 2026 had the highest probability. But then as soon as that conflict started, this light blue line here representing 0 Fed rate cuts really started to take off. So the market started the year expecting, between 2 and 3 Fed rate cuts throughout this year. And right now we're expecting 0 Fed rate cuts. And the sentiment has switched so much that even we can see that, how many Fed rate hikes in 2026, the probability or the odds of a Fed rate hike, right here, you can see it started to come up in March, and then, we were supposed to end the conflict quickly, so that probability came down, but now it looks like the conflict is extending. So we even have, the idea, this is like a 50-50 chance, but the interesting thing on this chart is to see the upward, how far it jumped up and how quickly, just within a couple of months here, up to 50%. Now, if there's a resolution, hopefully we'll see this 55% come back down a little bit.
Yeah, and also, Jed, next week the new Fed governor is convening his first meeting. We'll get a feeling for, maybe a little bit of a feel for how the Federal Reserve might behave in the next year.
Yeah. Yeah, I'm looking forward to seeing what Jerome's predecessor has to say.
Right.
Okay, let's keep going. Okay, so that's kind of the end of the interest rate. Thanks for bearing with me. I know that was a lot on interest rates, but I just kind of wanted to give a lot of context around what the interest rate markets are looking like. So we'll move on to why owners aren't selling. And so this is kind of what I think is also I'll call it a major dynamic or influence on the local Bay Area real estate. And Bay Area real estate is different than the rest of the nation in a couple of ways. The whole nation is subjected to this one, mortgage rates. Okay, so this is the mortgage rate issue, and we'll call it a lock, this lock number one for mortgage rates. That's not unique to the Bay Area, that's nationwide. But unique to the Bay Area are the property taxes in Prop 13, with which Jim, you talked about, and then also this capital gains issue that we have here in the Bay Area. So we'll move on, and I'm going to go through an example. I'll try to go. There's a lot of numbers here, so I'll try to go kind of fast, and if you guys can slow me down or ask questions. I just don't want this to get too tedious, but it's a lot. So we'll go through an example here. One family in 11 years, we've got, and this is an example. And again, every home ownership, I feel like it's like a fingerprint. They're all different. And like Jimmy said, yours is very different than a lot of people's. And so the example I'm going to run through here is not meant to encompass, every single scenario, but it's just kind of let's call it kind of a common scenario that we see here in the Bay Area. So let's say a husband and wife purchased a home in 2015 for $750,000 with 20% down, and at that time they could get a rate of 3.875. So their principal and interest payment on that would be 2821, and then their property tax would start off at about 781 per month. Okay. Um, and these factors are based on 1.25% times your purchase price divided by 12 months. 1.25% for the property tax rate is a little bit high for some of the Bay Area cities. A lot of times it'll come in reality closer to 1.15 or 1.17. And then in the East Bay, there are other property tax scenarios where they have like a Melrose tax where this factor can come up to as high as 1.6%. So property taxes can vary, but for this slide deck, we're going to use 1.25. So, and then we'll say in 2021, this couple decided to refinance at 2.875. Now, over those, say 6 years, they were able to pay down their mortgage a bit. So now the new balance is 540,000. They refinance at 2.875, and now their principal and interest comes down to 2240. So they started out at 2821, comes down to 2240. and they're locked in for 30 years at this rate. And if we look at today, they have a principal and interest is still the same, 2240. Now their property tax does go up a little bit. The Proposition 13 allows the assessed values to go up 2% per year. So their property tax goes up from, started out at 781 and 11 years later here it's at 971. So if we add these two together, the total is 3212. And then let's say their market value of their home is roughly about 1.5 million today. So they started off at 750 and they're up at $1.5 million today. And then we say, okay, now this homeowner or this couple is thinking about moving. So we model this out and we say, all right, let's say we sell at 1.5 million and we're going to pay off our loans. We'd pay off a loan balance of 476,000 and selling costs about 6%. And what I included in here was a number of things like real estate commissions, some closing costs with title and escrow. And usually when people sell a home, they may paint the interior, paint the they spend a few dollars to spruce up the property. So we'll call that 90,000 in total. So their net sales proceeds would be 933, almost 944,000, 34,000. And then they have this capital gains that they'd be subjected to. And this is the summary, but I'll have another slide where we break out this number. But they'll, pay roughly 39, almost 39,000 in capital gains. So their cash in hand at the end of the sale would be just about a little less than 900,000. And they say, okay, we're going to buy a property at 2 million. So we'll use an 800,000. We got, 895. So we'll take 800,000, use that for the down payment. We'll take a new loan of 1.2 million, and then we'll take an interest rate of 6.5%. So that's the scenario.
Yeah,
And
can I just say that can't
sure.
be California. That capital gains tax looked mighty low. So that's probably not a California slide where there's no long-term exclusion.
So I have another slide that'll break out the math, and you can check my math for me there. So let me move. I'll get to that. I'll get to that. Okay, so if we look at the mortgage rate, we've kind of already talked about this, but right now, if they stay in their home, they have this payment of 2240, and if they move to the new home, maybe their family's expanding and they really need a bigger home. So now with prices where they are, they have to spend 2 million to get where they want to go. Their payment jumps up, by $5,000, over $5,000 a month just to do this move. So this is the interest rate lock for the Bay Area, I think is real, and it's one of the three that really disincentivizes people to move, to sell and buy. Most homeowners, when they sell, they're buyers, right? They sell and they buy another home. And that sell and move up buyer segment of the market is really kind of locked in with the three items, but this mortgage interest rate one is particularly impactful here in the Bay Area because our home prices are so high, which means our loan amounts are so high, which means our monthly payments are so high. So for a homeowner, even if they have a pretty good salary, to go from, 2,200 up to 7,500, that's just a massive jump. And this is one pretty strong reason for this couple to elect to stay where they are and maybe just do a remodel, expand, add another room or two instead of jumping into a $2 million property with a larger loan and a much larger payment. So if we go and we look at the property tax component, how is that going to compare? We have our Prop 13 tax growth at 2% per year. So if they started off at 750,000 over the 11 years, their new assessment in 2026 comes to 932, which brings their monthly property tax rate or payment to 971. And if they at the sale, when a property sells due to Proposition 13, the property is reassessed at the sales price. So, or the county reassesses the value at the sales price. So if the homeowner sells, they buy a $2 million property, or the homeowner buys a $2 million property, they're going to start paying property taxes based on $2 million versus 932. So what does that do to their property tax? Well, it essentially over more than doubles their property taxes each year. So this is another, I'm calling it lock two. So this is another component that locks Bay Area homeowners into, not selling, not selling and buying, which is exactly, Jim, what you were saying earlier. Uh, so if we keep moving here, the next thing we'll look at is the capital gains. And so here was how I worked out the capital gains. And if we look at the sales price at 1.5 million, and I left their basis at 750,000. Now this is maybe not realistic. I left it here to keep it simple for the presentation, but if a homeowner over the years maybe upgraded the kitchen or bathrooms, those are capital expenses that can be added to this and actually increase the basis to decrease their capital gains liability. But for the purposes for just for this presentation, I left the basis at the purchase price of 750,000. And so we have the cost of sale that we already talked about of 90,000. And this is for a married couple, so their capital gain exclusion is 500,000. So if we subtract all these out, they're left with a taxable gain of 160,000.
Yeah. So Jed, I think your math is all correct. What threw me off though is your 1.5 million price is probably more likely like 3 million or 2 million in the Bay Area, and then the capital gains exclusion becomes a smaller percent, and of course you're in a much higher income tax bracket. So that's what threw me off. I think your math's all correct. It's just that if you're in a more expensive home, it doesn't change linearly. It changes like exponentially more tax.
Yes. Yes, you're exactly right. And I tried to hedge a little bit at the beginning, honestly, by saying, this isn't meant to encompass all scenarios. I think, you're 100% right because we talked to a lot of homeowners that have, this presentation is based on somebody who purchased their home in 2015. Okay, but there's huge, many homeowners in the Bay Area here purchased their home in 80s and 90s and 2000s. And, at that point, their basis is extremely low relative to the value today. So yeah, they could have bought a home for two, three, 400,000 that's worth, 4 million today. And, they'll have a seven-figure capital gain, um, which is translates into a huge check to write to Uncle Sam and to California. And you're right, if you have a higher income, so I used 15%, which is the long-term capital gains rate. But if your income is higher, this goes to 20%. And even in this sort of the most conservative one, paying federal and California state, the homeowner's still paying almost $39,000 extra just to move up. And so this is another reason that holds people back. And a lot of times, and we also see, empty nesters that would really prefer to move to a smaller home, but they don't because of this capital gains liability. There were some bills in Congress that did not pass that were um, put forward to raise the capital gains exclusion from 500 to 1 million for a married couple and 250 to 500 for a single
Yeah.
person. But
Or the other thing that would work is to index capital gains for everything, for
yeah,
stocks and real estate. And there is some momentum on that. And then the question is, if the federal government does it, will California follow? And and
yeah,
probably not, but I think that would make it, in my case, and a lot of people, that would make indexing capital gains, because I've been in my home 35 years.
yeah,
So that would make a huge difference for
yeah,
a lot of people.
yeah. And that's one reason why I think our inventory is tighter because people are just staying in their homes longer and not selling and buying. And then the other component to the inventory is like you hit on it, Jim, but we don't have a lot of land to build here on the peninsula. So, it's not like we have a sprawl where a big home builder can come in and, throw down a few acres of tract homes. So, yeah, inventory, it's that supply and demand dynamic. There's lots of demand and limited supply. So moving on. So just to sum these up, we've got the rate lock that's in this case, this homeowner would end up increasing their monthly payment by 5,000, their property taxes would double, and on top of that, they have to write a check for their capital gains. So these are the three locks that I think are having a big role in the local real estate market. Um, I already kind of summed it up, so that's that. And another thing I wanted to mention just real quickly here, if you're on X or Twitter, there's a lot of I think it's wishful thinking, people wanting to or hoping that there's a foreclosure crisis coming so that they can come in and buy properties at a significant discount, which would be nice. I think we would all love that. But it's really my opinion. I just, it's not going to happen. And if we look at this chart here, really, let's focus on the blue line, which is mortgage delinquencies. And if we look at back 2008, we saw, which is, kind of ancient history now, but we saw how far the delinquencies came up. And these are 90 days delinquent for loans.
So, Jed,
And
this is home, right? Not commercial?
this is correct. Yeah, this is
Because
residential
commercial
real
shows
estate.
a very different trend, right?
Yes. Yeah, this is residential.
Central business district commercial is under tremendous pressure, right?
Yes, that's right. Yeah. Yeah.
Yeah.
So these are mortgage loans for single family homes and condominiums. And so back in the worst financial crisis that we've had in decades and decades, we saw the delinquency rate come up to, call it 9%. And then it just really, this blue line really came down, down, down. We reached the bottom here at 2022, and it has come up a little bit. And so a lot of headlines, I saw these headlines saying, mortgage delinquency rates doubled, they're up 100%. And so people are like, oh my gosh, great. We're gonna have all these foreclosures. We can swoop in and buy properties cheap. But, yeah, maybe if the rates went from a 0.5% to 1%, you know, that's not really signaling a huge wave of foreclosures. So I kind of just wanted to show this to dispel that myth. And the other thing back here is, you could buy a home with zero down, with zero job, and with zero credit. So if you had done that and you bought your home, and then as this crisis moved forward, your home value went down, even if you could still afford to make the payment, which a lot of people couldn't, and they were forced to go into foreclosure, which caused prices to come down. But a lot of people here in the Bay Area, because they had good jobs, good income, they could actually afford to make their payments. But they looked at the economics and they said, okay, I own a 700,000. I own a home that's worth, say 500,000, and I have a $700,000 loan. This doesn't make economic sense for me. So they would elect to walk away. And they thought, okay, so my credit report gets trashed for a few years and then it'll come back. So that was another thing that happened back here. And the reason I say that is because those were homes that were underwater. We call it underwater, where the home value is less than the loan balance. And out here today, we don't have that situation. Equity levels, I think, are at record highs. So if you do have somebody who's in kind of a crisis, financial crisis, and they're no longer to afford their mortgage payments, they're more likely to sell than to let the property go to foreclosure. Because if they sell, at least they will be able to realize some of their equity. Back here, people would sell or let it go to foreclosure because they had no equity. They had negative equity. So, um, okay, so that's that. And then the next one to talk about quickly here is the condo versus single family. There's one dynamic that's happening with the condominium market. California Senate Bill 326 and then also Senate Bill 721. These are basically the same, but 721 applies to multifamily rental units for 3+ units. But what this is, if you remember several years ago, the balcony collapse in Berkeley, where students were, having a good time and the balcony collapsed and um, a few of them had died. The California Senate Bill 326 came into effect as a result of that. And what this requires on condominium projects, exterior elevation element inspections. So these are going to be balconies, decks, stairways, and walkways. Anything that's exterior on the building needs to be inspected for structural integrity. And the inspection requirement went into effect January 1st, 2025. And what's happening with condominiums is they go get these inspections. The inspector comes out and inspects all of these elements. And, most of the time they find deferred maintenance issues. And, these are balconies and decks that create, with the deferred maintenance creates life and safety issues or health and safety issues. So the HOAs are saddled with this bill, this fee, this construction fee to go and fix all of the um, or shore up all of the elevation elements. And that's an expensive endeavor. And so number one, they're raising the HOA fees to cover those, or they'll issue a special assessment to raise funds to cover the cost there. And then number two, mortgage lenders are not writing loans on condominium projects where they have these deferred maintenance items. And the buzz term is critical repairs. So if the inspection report, and that's the term that all these inspection reports include, they define these elements as critical repairs. If it's a smaller repair, like maybe just chipped paint, the chipped paint where it doesn't have any kind of a structural integrity issue, that's okay. But most of these elevation elements have structural issues that could lead to a collapse. And lenders don't touch condominium projects that have these balconies or elevation elements needing critical repairs. Um, so what happens is when a lender does a loan on a condominium project, they contact the HOA, the homeowners association, and ask them, have you had any inspection reports done in the last 3 years? And by law, they were supposed to have one done by January 1st, 2025. And so if they come back and say, yes, we've had inspections, the lender says, all right, show me the inspection reports. And so the underwriters review the inspection reports. And if there are critical repairs, the next question is to the HOA, have you done anything about it? Have you fixed these? Are these items repaired? Most of the time, the HOA comes back and says, no, we haven't done the repairs, or they're in progress, but they're not finished. And so at that point, the lender won't make loans on these condominium projects. So even if you have this unit here has a structural issue that doesn't affect any of the other units, lenders, mortgage lenders are conservative. They view the entire project as tainted, and they won't touch it until they can get a clearance report showing that all of these items have been repaired. And then Senate Bill 721 is important for real estate investors that own multifamily properties for liability reasons. If they're required to get the same inspection and to repair the same elevation elements. And if they don't, and there's an injury on the property, that just opens up uh, tremendous liability for the property owner. So that's causing HOAs, the condo market, to be much softer than the single family home market. The other thing is the insurance. California, a lot of insurance companies left or are no longer writing insurance policies for single family homes, although they're starting to come back. The last year and a half, we've seen insurance companies start to write policies again. But the same thing happened to condominium projects on their master insurance policy. A lot of those policies were not renewed, and for the HOA to find a new policy, the new policy had a much higher premium, so they passed those premiums on to the condominium owners by increasing the HOA fees. So HOA fees we've seen really go up a lot over the last couple of years for condominiums. And so with the lack of financing availability and the higher HOA fees and the fear of getting a special assessment from your HOA to cover costs to repair all of these, the condo market is just soft. So um, that's the difference. And none of that is happening with the single family homes.
So, Jed, it looks like we've got time for a brief demo of the mortgage lens. Why don't we take a look at that?
Okay.
Is that okay? Or
Yeah, sure. Yeah, yeah. If you guys want to move on, we can do that. What this is, I'll try to go quick here. And you're right, this is so small. Let me see if I can,
is there a way to bump the font? There
how
you
about,
go. That looks better.
yeah.
Thank you.
To basically come in, it's called themortgagelens.com. And so you come in and you kind of specify what you are. I'm going to click homeowner. I'm a homeowner here. And then now, once you click that, the text gets a little bigger. So I'm going to zoom back out. Um, I'll zoom out to there. And so the purpose of this tool is for homeowners to, or start, I should say, prospective buyers to assess their purchasing power without having to talk to a lender. And so this is a calculator that's completely lender agnostic. Like it's free. There's no sign up required, no email required. Th This is not a lead magnet for my own personal mortgage production. This is just a tool that I built because this is what we do to calculate or to determine a borrower or buyer's purchasing power. So what you can do is you can come in here and select a county or a city. So we'll say Santa Clara County. We're going to do a single family home. And let's say we're going to, buy in Gilroy. And let's say the credit score, they type in their credit score. Let's say it's 780, good credits. Typically have good credit scores here in the Bay Area. But the other piece that this tool is endeavoring to do is sort of educate home buyers as well. So a lot of times when people see their credit scores, they come from Credit Karma or something, which provides a consumer credit score, which is oftentimes, not often, always is higher than the mortgage credit score. So we have a little note here that says the following calculations are going to be based on a little bit lower than what they typed in. And we're going to see here, let's type in the gross income. Let's say the monthly gross income is, let's say it's 15,000. Okay, and as soon as you type that in, you'll notice over here, this piece pops up showing what your purchasing power is. And you can see it's in red right now, and the little note here indicate or let you know that this is just an estimate. Really, all these numbers are estimates, but if you enter more data, meaning the debts and the assets, you'll get a much more accurate number. And so this is the quick and dirty way. Let me go back. So you can do it very quickly if somebody doesn't want to spend much time. They make $15,000 a month. The monthly debts, let's say they spend, $700 total on credit cards and car payments. They have those monthly debts. Notice the purchase price updates immediately. And then let's say they have, somebody has 250,000 to spend on a home. Okay. So they entered these three items and you can see it turned orange here to give you a little bit higher level of confidence in the number. But if you enter in the, you know, much more detailed, and I'll just do this quickly. Let's say we have that one. And let's say we have some bonus income and we'll go yes. Let's say this year was 25,000 and last year it was 20,000. And then we're going to say let's add some debts. We'll add a credit card. Let's say we have like 1,500 on a credit card and the payment's $50. And then let's say we have as you enter these, there's like customized notes that pop up here depending on what is entered. So we're going to enter, let's say we do, let's do a car loan here. Say the balance is 35,000 and let's say the payment is 600. And then we'll add, let's add a student loan. We have student loans. Let's say we have 35,000. Let's make it different. We'll go 30,000 student loans and they're making monthly payments because all of these questions that I have designed into this are questions that determine this end number. So depending on the individual situation, and let's say they pay, $100 a month on their student loans, those are the minimum payments. And then we'll add more details in the assets. We'll add an account. We'll just do one savings account. Let's say we have 250,000 in there. We'll add that. And now as soon as we have all the detail numbers in here, this turns green, which indicates a higher confidence level on what they would qualify for. And what this is this is the absolute maximum purchase price that this scenario would allow somebody to qualify for purchasing this amount with that income, with these debts, and with 250,000. And you can see here, if you scroll down, it gives you a summary of the monthly payment estimate. But these are the debt to income ratios that lenders look at, and it maxes them out. So this is 49.8. Typically, the maximum debt to income ratio allowed is 50%, 50. So, but a homeowner might say, well, that's great. I can qualify for almost 1.5, but I certainly don't like that payment. I don't want that payment. So the next question is, how do we, and see the system, what it does is it maxes out the debt to income ratio and it also maxes out the amount of cash they have. Because remember, we typed in 250,000 here. So it uses everything. And this really is the absolute maximum, but that doesn't necessarily mean somebody wants to go that high. So a couple other features that this has is it'll tell you like if it'll say, if you pay off your credit card balances, it's going to increase your purchasing power by 7,000. If you pay off your auto loan, you're going to remove that $600 a month payment. So that's going to add 85,000, almost 86,000 to your purchasing power. And then same kind of calculation with the student loan. And then this is the feature here where we come in and we say, all right, we don't like this monthly payment here of 98,000. We're really looking for a payment of let's say 7,000. Okay. And also we don't want to spend, 250,000 is all of our savings. So we only want to spend, let's say 150,000. Okay. So at that point, these numbers here adjust immediately to show what the numbers would be. So if you only want a $7,000 payment, that's going to bring your purchasing power down to 1.1 million. And then if you want to, if you can stomach a little higher payment, you can go with a $150,000 total cash to close. You can go up to a $1.3 million property. And then there's a little amortization schedule here if somebody wants to nerd out on the amortization schedule. So that's the product.
I think this would be very helpful, especially for young people or first-time home buyers.
Yeah. And so the idea is to be able to come in here and get some pretty accurate feedback on your purchasing power without having to go through the rigmarole of engaging with a lender, having your credit report pulled, submitting your paychecks and bank statements and I launched this like a few weeks ago, but I'm noticing I'm a little reluctant because it's pretty tedious to go through all this, and this is what we do as loan officers.
Right,
So I'm
but
not sure how much demand a
it's no more
consumer's.
tedious than the real app. It's probably 1/10 of the of the hassle of a real application.
Oh, yeah.
Yeah.
I think you're
Um,
too hard on yourself here, Jed. I think this is actually useful.
yeah. Well, so my idea was eventually, if people love it, I would convert it into, we'd add in a place where you could sign up for it, create your own account. So you could save these numbers because right now there's no sign up. So as soon as you log out of this and log back in, all of this data goes away. You can't, revisit it. If you go with the same browser, actually, it will save all this information in your browser, but that's all it does. And then the idea is like the end vision would be to have consumers, because right now the mortgage industry is such that if you need a mortgage, you have to contact a lender. And once you contact a lender, a lot of times that information is sold. And then the consumers are barraged with, texts and emails and phone calls soliciting mortgages, which is a broken system. It's incredibly annoying. So,
So one question on that. What is the value? So let's say I fill out a real app with a lender. How much do they sell that information for? Is that 50 cents, a dollar, $2?
yeah, so that doesn't really get sold. The lender doesn't really sell that, but what happens is when you pull the credit, um, the credit bureaus, Experian, Equifax, and TransUnion, they sell that mortgage inquiry data. So they will say, oh, this social security number has this phone number and this email, and this person just had a lender pull their credit report, so they're in the market for a mortgage.
And roughly what's that go for per name?
Oh, you know what? I don't know because I don't buy those leads. But mortgage companies, other
But
mortgage
order of magnitude, do you think it's a dollar, $10, $100, $1,000?
companies. It can be upwards of like $200 or more because there's a whole pricing tier because if you want exclusive leads, where a lender will say approach TransUnion and say, I want to buy your leads, but I want exclusive leads. I don't want you to sell these to anybody else but me. TransUnion says, okay, it's going to be more expensive. Or they could say, that's fine. I'll just buy what I want the cheapest tier. And at that point, they're going to be selling those leads to multiple different lenders, which is usually.
But I might, so I'm trying to flip it around. So as a consumer, as a potential home buyer, I might spend $10, fully acknowledge it's just an estimate.
Yeah.
but postpone the barrage of inquiries for a little bit to see if there's issues that I've got to get cleaned up. I have to believe that there's organizations that help people um, I mean, there's probably a bunch of ways to. I'm getting off the topic, but it seems to me there's a lot of opportunities for this.
That's my end vision is to have consumers use this, create an account, save their data. Once they have it pretty locked in, pretty tight, the vision is to actually have them invite lenders to quote them, as opposed to the other way around, where consumers reach out to lenders for a quote. But they could have all their data here, and then they could click a button on their choice. They control their own data, and they
Well,
could,
but once they leak it to the vendor, then the game's over, right?
not necessarily, not unless the credit's pulled. Yeah. So, um, yeah, and at least I don't think so. Let me pause on that a little bit. Maybe I haven't thought this all the way through. I guess my point, I was starting this thinking, okay, if there's a lot of demand for this product, then we could go down the road of implementing some kind of a monetization, just like you described. Maybe $10 you get to use this and work your data, and then you could eventually. There's a system called Plaid. I don't know if you've heard of that, but Plaid allows consumers to integrate their paychecks and bank statements. So if Plaid was integrated into this, the user could click a button and have their, paycheck income automatically populate and their bank statements automatically populate, which makes this number much more accurate.
This has been very helpful. I'm glad you're willing to make the slides available. We'll definitely publish this, um, the video and the slides. I think that the thing that's exciting to me about what you're doing is that you're looking at something that might be controlled by the buyer, versus a third party trying to monetize it. Um, so I think it's I think we're going to wrap here unless there's any final questions.
Well, I'm just wondering, my question, prognosticate, what do you think of the future? As best since you've looked at, sounds like you've devoted your life to this. Where do you see things? Where do you see the trend going? More of the same?
Yeah, in terms of I think you hit the nail on the head when you said, what's going to stop this market? What can stop it? And yeah, I'm with you. The only thing I see is if there is a major crash in technology, because all the technology companies are what are bringing all the dollars and wealth into our community, and so we have lots of demand, capable demand. We have capable home buyers, and we have limited inventory. So until the buyers are no longer capable and we don't have that demand for property, we're going to see property values continue to go. I mean, there are crazy stories in San Francisco where first-time home buyers are wanting to buy $3 and $4 million properties as a first-time home buyer, coming out of the AI companies. There's just so much capital and just so much high wages. These engineers are making $1 million a year in salary, um, to be, so I don't see the market slowing down. I do know Santa Clara inventory in Santa Clara is coming up a little bit, compared to San Francisco. San Francisco is the hottest market right now. It's insane. Um, and you usually over the years that San Francisco is kind of the starting point, and then that demand sort of trickles down the peninsula because prices become more affordable as you come down, and then as you go over to the East Bay, prices are a little more affordable. So, unless there's some major shock, some kind of black swan event that none of us can predict, I just don't see this market changing much. I see prices continuing to either at least stay flat. Um, Now, in general, now are there certain pockets that are going to change? Yeah, certain neighborhoods, East Palo Alto is a different one, and there are neighborhoods where property values are going to change, but just sort of general in the peninsula, I think we're going to see at the very minimum, flat home prices and most likely
Are
elevated.
Jed, are we the number one highest price market? I know Washington, D.C. is pretty high. There's some other areas, but I would guess if we're not already, we're going to be number one.
It's right up there. There's some pretty high price market. Of course, most of those burned down last year, down in Los Angeles. Um, the coasts have the highest prices, New York and California. And I think it was Atherton had the highest median home sale price in the nation. I'd have to check that. Those stats kind of change a little bit, but yeah,
But the Bay Area
this
in general.
Bay Area is, especially the peninsula here,
Yeah.
the southern peninsula of the San Francisco Bay is just a really unique market because there's just so much demand and there's just not a lot of room to build. So,
Yeah. Well, thank you. This presentation's been great.
wow.
All right, we'll break here.
Okay.